After taking a bit of a dip on Monday, gold still hovering near its record highs of $1,300 an ounce. We're joined now by Frank Holmes. He is the CEO and Chief Investment Officer of U.S. Global Investors. It's a money management firm with about $2.6 billion in assets, and he manages two of the top-performing funds in their categories, the World Precious Minerals Fund and the Gold and Precious Metals Fund. And Frank, we've been talking for over 10 years now, and during that whole time that I've known you, you've been relatively bullish on gold. Do you still see more upside ahead for gold from here?
Absolutely. Especially right now, we're in a season of giving from the heart. Besides the buyers that are speculating that there's going to be massive currency devaluations and printing of government. California talked today again about IOUs. So if you just take a look at the size of the California economy relative to most countries in the world, it's a significant factor. But what's important to take a look at, Aaron, is that the gold and silver have not gone through the 1980 inflation-adjusted prices, whereas most other commodities have. And if we were to go through those 1980 inflation-adjusted prices, gold would be at $2,300 an ounce today.
Right, so is that your target? Is that a fair target for gold?
It's a fair target, and if you're a real gold buck, I mean, if you're a real thesis of when there was a gold standard and the amount of paper money outstanding relative to your price of gold ratio, gold would be at $50,000 today. And if you were to 1971 price levels to debt when gold became free trading, you'd be at $5,000 an ounce. So I think over the next 5 years, it's pretty easy to lay up that gold can double, and that would be a 15% compounded rate of return.
So I remember the dot-com era fairly well, where people were talking about the same sort of stuff. These companies are changing the world. Sure, it's eyeballs. You don't know how much they're worth, so they could be worth X if such and such happened, and they could have been. With gold, how do you figure out what some sort of fair value is for gold and what your downside is? Because obviously here there's been such a run that there has to be tremendous downside if suddenly people change their mind and say, oh, it's just metal.
Well, that's a great question. And if you looked at the math and all those parabolic moves, there's basically a math to a bubble. And if you compare that and overlay to gold, gold's far, far behind. There's no bubble. And most people I speak to are always saying gold's not going to go up. I mean, my thesis with you for 10 years has been gold would rise in the first 10 to 15 years on deflation. And what's significant is from the 70s is that Chindia, affectionately known, China and India, they had no global footprint in in the 70s. Today, they're pushing 15% of global GDP. Very, very different. And they're big believers of gold from the heart. So you have what's called the price takers and now the price makers basically lining up saying, we're concerned about paper currencies. Bangladesh, only a couple of weeks ago, is making shirts. They're saying they just don't want to have dollars and sterling and euros. They want to have some gold. That's a very poor economy where the average person makes $100 a month. In their foreign reserve component, they want to trust gold. That's the sea change. Right. And the last thing to share with you, all the pension funds, all the endowments, they're not running into gold yet. And what they did at these other previous peaks, they all piled into technology at the very top, and then they piled into all the private equity back in 2006. Most of them are doubting that gold can trade higher.
So wait for them to pile in and then run for the
That's a good precursor.
Right, so we're hearing about central banks. They're stopping their sales of gold. They're not buying gold yet. That's another potential big buyer that's out there, right?
That's correct. And money supply. It's a real simple, there's these big S curves. And you're halfway through this S curve. And we're going to get inflation, but probably in 5 years from now. And everyone's so anchored to worrying about inflation, the majority of people, it's real deflation fight right now. So government policies will be to create jobs. And they'll turn around and print a lot of money to try to support the deflation. This basically makes gold attractive. And the supply of gold from mines is decreasing. It's very hard to find a 10 million ounce deposit. And it's much easier to invent a new piece of technology than it is to go find this thing that Mother Nature is creating.
So you say gold can double over 5 years?
Yeah, I think that's very reasonable because money supply is going to probably around the world is probably going to triple.
Now, what about the downside? Because here we were at 400 forever, low of 250, something like that. Now we're at 1,300. It gets cut in half. That kind of erases your doubling on the other side. Isn't it reasonable that it
It's
could
a
get
great
cut
question. What you find with gold is if gold spikes quickly, the dominant buyers, the jewelry buyers, those with their heart, and we're going into the season of lights in India, those types of buyers stop. As soon as gold has a $100 to $200 correction, they come back in. And what you're seeing is so different coming back in the 70s is 40% of the world's population believe in gold, and they give gold as gold gifts. That's very different than here.
Right. So before we wrap, I should know you co-authored a book, The Gold Watcher, Demystifying Gold Investing. What is your advice for individuals? Should you buy bullion? Should you buy jewelry? I know you guys focus on the gold miners, and obviously people can invest in your funds if they want, or the GLD. There's so many different ways to do it.
First of all, for the one you love, buy gold jewelry, high quality gold jewelry, and you'll get big brownie points. and then two, you look at good quality gold coins. And then if you're going into financial markets, you're going to look at the gold ETFs and gold equities, unhedged gold equities. I wouldn't be buying the gold equity ETFs because when money surges into those particular vehicles, they spike up and they trade at a premium. And anytime gold's down, they trade at a discount. So if you take a look at money flows into the gold equity ETFs, it can cost you between 3 to 7% a year. And with the gold active money management, I think you can actually outperform, and we've shown that.